Three stocks to buy before they recover. Many of you guys have asked me to do an update on three highly requested stocks. A lot of them are trading near their 52-week low. I use any screener and I go every Saturday or Sunday and I check out stocks trading near their 52-week lows. And you could find some companies like Starbucks, which you wouldn't expect is trading near their lows. A lot of companies like Zoetis within the pets. Pets is a huge area, huge market. Chipotle is at 52-week lows. And there's a lot of interesting stocks that you might find. So this is something that I do every weekend, and I'm going to talk about those three stocks today. So I really hope you enjoy it as always. The first one is CRM, and CRM, I did a video on it before. I told you guys the stock was a trap. So I'm going to do an update here because the stock is down a lot since, and I have to talk about it again. Now, CRM's last quarter was actually pretty good in my opinion. They got 10% revenue growth, subscription is growing at an 11%, operating margin has massively improved. It's now at almost 23% operating margin. So things don't really look so bad if you look at CRM's latest earnings report. But the biggest problem that CRM is facing, and maybe Adobe, but even a little bit more CRM, is AI. And this is a very funny meme I saw on X where it says Benioff realizing that every high multiple acquisition he made over the last 10 years is now worthless because of AI. And CRM is very well known for overpaying for acquisitions. They always pay up for them. Some of them work out, like Slack. I thought it was too expensive, but it did, drive some revenue growth for the company, and it did actually work out too well. But a lot of them, they just pay the high multiple, and a lot of those businesses have low barriers to entry. So, it could be disrupted by AI, and this is 100% true. And this is one reason why the stock has been going down. But the main reason why the stock has really been struggling is because we can pretty much confidently say that revenue growth has peaked. I mean, they used to grow revenues 32, 33%, 26, 28. I think those years are over. And now they're growing 8%, 8%, 8%. So I think 8 or 9% is the new normal. And I highly doubt CRM will get back to growing 24 to 28%. They did do a lot of acquisitions. The company grew in market cap, but there's only so many acquisitions they can find at a good multiple where they don't massively pay up for them. And the core business is growing. It's not rapidly growing, but it is decently growing 7, 8, 9%. I think this is the new normal for CRM. And it's the same thing quarter on quarter from 25% to 7.6%. So again, this is a massive deceleration in growth, and that normally kills a lot of those stocks. Now, looking at the company's multiple, it's now, again, much better valued. It's trading at 16 times price to free cash flow. So 16 times cash flow looks cheap. For CRM, it used to trade as high as 55 times with an average of 30 times. And now you could buy CRM for 16 times cash flow. This is absolutely insane. Now, I'm using cash flow over here for my valuation because the company has a lot of depreciation and amortization, which we have to adjust for them. But then they also have massive stock-based compensation, but they're pretty much the same and they equal themselves out, which is why I prefer to use free cash flow for a more accurate metric. Now, for CRM, to me, it's very simple, and I'm still kind of doing the same thing I did in my last video. I look at free cash flow growth. It went from 30% to 9% to 13% expected in 2027 and 12%. So maybe CRM can grow free cash flow 12 to 13% without doing any crazy acquisitions. Now, if that's the case and the stock is trading around 16 times cash flow, I would expect a 12 to 13% annual return on CRM, excluding a potential multiple expansion. With a multiple expansion, I don't believe it's going to go back to 30 times or something crazy, but I can see it go back to 17, 18 times, maybe 20 times maximum. So I'm saying 12 to 13% on the low end without any acquisitions. If they do acquire something crazy, it could boost them even more. On the high end, it could be maybe 15, 17% if they can get a multiple expansion. So I actually believe CRM is starting to look interesting over here from a overview perspective. It's starting to look very, very interesting. So I believe there's a lot of bad sentiment around the SaaS stocks. You could say CRM is kind of one of them. Adobe is one of them. I like Adobe very much. At least they don't overpay for acquisitions all the time. But CRM is not bad over here. And I think it's a much better buy than what it was before. Now, the second one, which also was a highly requested stock, is FTNT Fortinet. And you have to remember, I'm doing an overview. I'm not doing a deep dive on every single stock. But Fortinet is a cybersecurity play, and you never, pretty much never see them down 16% and the stock not recovering. And this is what happened with FTNT. FTNT is an amazing company again. But the main reason why FTNT has been going down is because the company's statements, they put up a statement and they said that 40 to 50% of the accelerated firewall refresh was now completed. So every few years, the company has like a firewall refresh where they upsell a lot of products and a lot of things. They go into like a renewal cycle. And normally, whenever you have the renewal cycle, the company puts up massive revenue growth in their products kind of segment. But now it's 40 to 50% complete, and the company is barely growing 12% in revenues. And they said this is driving confusion about why FTNT is not seeing stronger product revenue growth, and it's really not seeing it. I mean, they're growing like 12%, I think, in revenues, or 11% in total revenues. And they were expecting more if 50% of the new renewal cycle is already over. So this is a major red flag, and the stock sold off, and I believe the stock deserved to sell off. The stock was, again, looking at revenue growth. Revenue growth has also peaked in general. It used to grow 32%, 28, 19, 19, 17. This is the lowest it has ever grown since 2010, which is 12 to 14%. So this is another amazing company where we can say that 20 and 30% revenue growth years are likely behind them, and maybe they're going to grow 12 to 13% in revenue growth, and that warrants a re-rating in multiple, which is why the multiple went from 80 times to 30 times, and not long ago it was at 42, and now it's trading around 30 times. So this is much more reasonable if you're looking to enter something like FTNT. But what FTNT is mainly doing is they're focusing on the services revenue. So a lot of the subscription, higher margin, recurring revenue stuff, not much on the product revenue. So the product revenue, as you could see here, it has pretty much stalled over the last 3 years, but they're not too focused on it. Their main focus is the services revenues. And if you look at services, it has been expanding exponentially, which has increased the company's net income margin to 29%. It used to be 21, 19, 18, 15, and has steadily increased to 29% net profit margin due to the services revenues increasing much more than the product revenue. So a lot of the analysts are freaking out over product, but the company is really focused on services where they have an edge, and it's much more stickier kind of revenue with a good competitive advantage. So at 30 times earnings for a company like FTNT in the cybersecurity space, which cybersecurity again deserves to trade at a premium with such high net profit margins, and the growth is not going to come back to 40 and 30%. It will likely settle down around 10 to 12%. So 10 to 12% for 30 times earnings. I would not say that FTNT is a bargain, but I would say that it's a very interesting setup where I would see again in 11, 12% annual return, but this is excluding a multiple expansion. And those kind of stocks, if you look at them, they very rarely stay at this multiple for too long before they get an expansion back to 30 and 40 times. I'm not saying it's going to go back to 80 times, because the growth years are over of 20, 30, 40%. But I can see 30 to 35 times, which would be pretty much twice the earnings per share growth of 12, 13%. It's really not too bad. So I like FTNT over here much more than CRM, to be honest, mainly because of the cybersecurity exposure. I also don't own it, but a lot of people in my group, they own the stock and they bought the dip, I think at $72 or $73. But I think FTNT is interesting. I'm not seeing life-changing returns from FTNT, but I can see a potential 15% return, which is a double every 5 years. And it would not be too bad in this market where cybersecurity is still hot. And FTNT looks very attractive relative to other players in the market. Now, the last one, which a lot of you have asked me about, is Chipotle. And this is another one that I said Chipotle is a trap. And I gave you guys my fair value of $33 when it was trading at $43. And so far, it's materializing, and it could potentially hit $33 per share. Now, Chipotle was just an amazing company. People believe the high quality and all these things. Amazing execution, by the way. It was up 4,500%, just one of the best of all time. And now it's not doing too well, and it's down 35% on the year, which doesn't happen very often with Chipotle. But if you look at Chipotle's comparable sales, which is an important metric with those restaurants, it went from 11% to 6% to 5% to negative, pretty much 0%. Now it's negative 4%. This is a massive change in trend in terms of same store sales, or you could say comparable restaurant sales for a company like Chipotle. And the rest of the numbers on the quarter, they were not good at all. Revenue was only 3%. This is a company that used to grow 10, 12, 15. 3% revenue growth. This is disappointing. Operating margin went down from 19.7 to 18.2. Restaurant level operating margin went from 29% to 27.4. Earnings per share also decreased 2.9%. So the company is really struggling after the CEO left to join Starbucks. Starbucks also not doing so well, but Chipotle is not doing well at all. They need a major, like they need an activist, or they need something to change the company around. And they're trying to do a lot of improvements within the stores, but they're also trying to expand internationally. For example, Chipotle right now is going to expand in Asia for the first time through a joint venture. We don't know how successful this is going to be, but it could potentially be successful. I believe they're going to expand in South Korea and Singapore in 2026. So it could potentially be a success. We'll see how the first or second restaurant does. Also, it's a different culture, but it could potentially be a success. So we'll see what happens. Now, with Chipotle's earnings multiple, it used to trade at 65 times forward earnings. Now it's trading at 29 times forward earnings, which I still believe 29 times is honestly expensive for a company like Chipotle. There's a lot more competition. Kava is very aggressive in the space, and you have many different players. But 29 times earnings looks much better than 42, but I believe it's still extended for a company like Chipotle. Now, for my valuation model on Chipotle, I used this 2025 earnings per share guidance of $1.21, which I believe is fair. Then the analysts are expecting a massive rebound in earnings per share growth to 17% over the next 2 years. I'm not sure that's going to happen. It's going to be very hard to pull off, but I'm going to assume that they can pull off some kind of a miracle just to make a point of how expensive the stock still is. So I put in $1.21 earnings per share for the next 5 years and 17%. I got $2.65 in earnings per share. Now, I told you the stock is trading at 29 times earnings. I think for such much lower growth, it's too high. And I personally would not pay more than 25 times earnings. So if I put in 25 times earnings, I'm getting $66.25 of earnings of price target over the next 5 years. And if I want to double my money with a company like Chipotle, I would have to pay around $33.12 per share. Now, $33 is still negative 14% from here. So, and I said it when the stock was at 43, which was not an easy thing to say, but I'm still sticking with $33. I think 33 on Chipotle looks very interesting as a potential small entry and dollar cost average down, but there's nothing that can prevent Chipotle from trading at 20 times earnings or 18 times earnings. There's nothing that can prevent it. They don't have the competitive advantage they had. They clearly don't have the pricing power that they believe they had. I think they went too high on prices, and a lot of people complained about that, and they switched to different places. Some of them, they prepare their own food at home. It's not so hard to replicate. So again, I think $33 is fair, and I personally would not pay much more than 33 and maybe dollar cost average down. But I think, again, there's way better opportunities in this market. My favorite one is FTNT for the cybersecurity space, my favorite ever. Then maybe CRM, and the last one would be Chipotle. And this is my video for today. Hope you enjoyed it. Not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.